Imagine this. You're 35, sitting on a beach in Bali, sipping overpriced coconut water, not because you're on vacation, but because your investments made work optional. Too good to be true? Not if you think like a genius, or at least like Benjamin Graham. Because The Intelligent Investor isn't just a book. It's a rebellion against get-rich-quick fantasies, and a blueprint for building wealth so durable, even a market crash looks like a discount sale. Let's dive into the book that Warren Buffett once called, by far the best book on investing ever written, and no, he wasn't paid to say that. Step 1. Kill your inner gambler. Most people treat the stock market like a casino. They chase trends, buy the hype, and panic when the lights flicker. Graham calls this speculation, a polite way of saying you're donating money to strangers. Instead, he urges you to be an investor. What's the difference? Investors buy businesses. Speculators buy tickers and pray. Investors ask, what is this company worth? Speculators ask, is this stock going up tomorrow? Graham's golden rule? Know the difference. Then choose wisely, because Vegas has better odds and free drinks. Next, the margin of safety. This is the single most powerful concept in the book. Imagine buying a used car. Would you pay full price without checking the brakes? Of course not. But people do it with stocks every day. The margin of safety means you buy a stock only when it's worth significantly more than what you paid for it. It's like getting a $100 bill for $70. This margin protects you from errors in judgment, unexpected news, or just plain bad luck. It's not flashy. It's not sexy. But it works. When markets crash, speculators scream. Intelligent investors go shopping. Meet Mr. Market. He's moody. You'll love him. Graham introduces a legendary character, Mr. Market. Imagine your business partner is an emotional wreck. One day, he offers to buy your share of the company at a sky-high price. The next day, he wants to sell you his share for peanuts. Mr. Market is irrational, unpredictable, and entirely uninterested in logic. Your job? Don't get caught up in his mood swings. Use them. When he's euphoric, sell. When he's depressed, buy. When he's confused, do absolutely nothing. Because smart investors don't follow the crowd. They wait, watch, and pounce like a cat with a PhD in finance. Active versus passive. Choose your player. Graham separates investors into two camps, defensive and enterprising. Defensive investors keep it simple. Think low-cost index funds, automatic contributions, and zero stress. If investing bores you, good. That's the goal. Enterprising investors are more hands-on. They analyze financial statements, study companies, and actually read 10 kiloseconds for fun. These are the nerds who enjoy spreadsheets more than Netflix. Both approaches work, but only if you know who you are. Pretend to be an enterprising investor when you're really defensive, and your portfolio turns into a junk drawer of regrets. Risk does not equal volatility. It's not about motion sickness. Wall Street wants you to think risk means price bouncing around like a toddler on sugar. Graham disagrees. To him, real risk is losing money permanently. Volatility? That's just noise. Prices rise and fall every day. That doesn't make them risky, it makes them normal. If your strategy depends on guessing short-term movements, you're gambling. If your strategy is built on understanding value, you're investing. One will cost you sleep. The other builds wealth while you're sleeping. Buy businesses, not tickers. Graham urges you to think like an owner, not a trader. Would you buy a dry cleaning business without knowing how much it earns? Probably not. Yet people buy stocks without knowing anything about the company behind them. Focus on fundamentals: earnings, assets, dividends, long-term potential. If the business makes sense, the stock eventually will too. Or, as Graham might put it, don't confuse a blinking stock chart with actual intelligence. The market is not your friend. Or your enemy. It doesn't care about your hopes, dreams, or clever Instagram quotes. It will overvalue junk and undervalue gems. It will make you feel smart on Monday and stupid by Friday. That's why Graham preaches discipline over emotion. Principles over predictions. Logic over luck. You can't control the market. But you can control how you react to it. And if you react intelligently, you win. Graham's final message: investing is not about brilliance. It's about behavior. You don't need to be a genius. You need patience, humility, and a well-calibrated BS detector. You need to ignore the noise, trust your research, and act when others freeze. You need to remember that money is a tool, not a scoreboard. And that long-term wealth is built not by being right all the time, but by not being wrong when it matters most. So, next time you're tempted to chase the next hot stock, remember what Graham would say. Buy low. Sell high. Think slow. Sleep well. And maybe, just maybe, you'll end up on that beach in Bali. Not by chance, but by choice.